I want to introduce you to these two guys, and as you probably are aware, this would have been Senator Kerry, and of course that's President Bush. Now in this example it's hard to see, but this cover story right here was my article on pivot points and the art of confluence of various time frames. Now this article was out in September of 2004's Active Trader magazine, and I'd written articles for Futures magazine as early as the mid-90s, and also we had articles in Futures magazine and other various magazines about pivot point analysis. In fact, one magazine quoted me as the pivot point maestro and one of the masters of pivot points analysis, and had a full 5-page spread on my history and how I came about using pivot point analysis back in the early 80s. So I've really been around the press an awful lot, and some of the things that I think that's really a compliment is there's a lot of educators who've picked up my work, compliment me on it, and are out showing others how they integrate it. And so that is something that's kind of neat. What I'd like to share with you though is getting it straight from the horse's mouth, and I think that's where you really will benefit, because I really don't share a lot of this information except for at seminars. And as you know, this is my first Forex course that I've put out that really expands on my first trading course, and I think that's why you're going to have a better, or at least a higher degree education in the art of technical analysis, combining pivot point analysis with candlestick charting. So with that, I'd like to share with you what this article was all about. Now, this was not regarding Forex, but it's kind of interesting how it applies to all markets. That article was talking about the stock market. Now, the stock market is, of all markets out in the world, the U.S. stock market, the S&P 500, is one of the biggest, baddest boys that represents all Fortune 500 companies out there. In fact, a lot of these international conglomerate corporations hedge and make money in the stock market by trading in the Forex. So it does tie in, and it is all relevant. I came up with the conclusion and put in my advisory service, and we put out email alerts based on this style of analysis, that we had a monthly resistance of 1161 in the S&Ps, the weekly resistance is 1162, and a daily resistance R2 is 1159 and a quarter. And if you average up those price levels of those confluence of resistance pivot point numbers, we came up with 1161. Well, the actual high in the March S&Ps was 1163.75, just 2 3/4 points off the high. The high for the year, and this is what's interesting, took less than 15 minutes to form. This is the actual chart. This is what it looks like. You're looking at a 5-minute chart. I want you to look at this formation right here. That, my friends, is called a doji. And we're going to get into a lot about the doji. That doji pattern right there, a very ominous sign. Think about it. This high right there lasted 5, 10, 15 minutes and was never seen again. In fact, I will tell you right now, we had a low close doji trigger to sell short the market. So this is way back in, of course, March of 04, and these signature patterns that we're going to be going over in this trading course were applicable back then. By the way, let me show you. This was the actual day. That's what the high actually looked like. And that high, by the way, I want you to look at that carefully, because that high lasted all the way, not through May, but June, July, August, September, October, until middle of November. We're talking literally close to 11 months. The high for the year held until after the elections. And that is kind of impressive, using pivot points and confluence of pivot points. So again, I want to emphasize to trade what the markets tell you. The strategies used here that we're going over in this course, combined with pivot points, especially the candles and the momentum studies that we're going to be teaching, are very powerful. They're time tested. Keep in mind, momentum is simply the difference in prices over a period of time. I'm giving you this formula because, number one, I want you to understand that I didn't invent this form of analysis, all right? Number one. Number two, I want you to understand that price is very important in market analysis, and so is time. So price and time, and that's why pivot points are so powerful, because they combine both price and time. So, but let me go through what momentum really is defined. It's defined as the current settlement price minus the settlement price from N periods ago, or X periods ago. So you can say what the strength or weakness of the momentum is by where price is, the current price, minus the settlement price of 10 days ago, 5 days ago, 50 days ago. So that's how you can utilize a momentum study, and there is a momentum indicator that uses that exact formula. But candles, they help, and they are the second dimension of what we're using pivot point analysis for, to help us identify the change in momentum in a visual approach, and that will help us calculate the momentum of the market. Now, what I'd like to get into right now is the moving average section of pivot point analysis, but first let's go over what moving averages are about. First off, the name moving average describes the calculation and the result of this indicator, which is simply a moving average, which is the most popular. Very much, I use a simple moving average in most of my analysis, as we will here in this trading course. Other moving averages include exponential, weighted, and variable, and of course you can do displacements by subtracting time periods. There are more complication and more complicated calculations. Just remember this. You want to have any type of an indicator. The least amount of time periods will make the indicator more sensitive to price changes. And again, with exponential and weighted and variable moving averages, they use, and they're a little bit more complicated, but their calculations make the indicator more sensitive also to the latest closes, by weighting the last close price or the latest closing price based on various formulas. Most foreign currency Forex platforms offer these as standard tools. Now, a simple moving average is simply you add up the sum of the closing prices by the number of closes. For example, if you take an 18-day simple moving average based on closing prices, take the last 18 days close, add it up, divide by 18, and that will give you your 18-day current simple moving average price. With each new day or time period, it could be 5 minute, 15, 60, daily, weekly, monthly, whatever your time period is. It's just whatever that closing price is, you add it to the new calculation, while the first closing price is eliminated. That is what we're looking for, freshening up an 18-day moving average, and that's why you look at a calculation that's called a moving average, because it moves. So you drop the oldest, add the newest, add them up again by 18, divide by 18, and there you have your 18-day moving average. Now, if you recall, we talked about the pivot point calculation, providing the mean, the average for the session's trading range. We take the high-low close, divide by 3. That's our pivot point. Well, the purpose of using the pivot point in the moving average calculation is that the pivot point will show the potential continuance of the trend, the strength of the trend, and the typical price. If you add the high and the low up, after all, that was a trading session. Activity took place. There was volume during that session. People remember who sold the low and the market rallied on them. People remember buying the high. They remember that price. They're scared of that price. They're fearful that the market breaks that low. So the low and the high are very important price elements. The close is obviously important. That's just an assigned price level. But if you combine the low and the high and the close, that gives you more truer indication of the true value of the market of that given time session. So the number utilizes the number, meaning the pivot point number, will utilize the cumulative data from the high, the low, the close for a given session. So that information provides what I call a clearer picture of the average true price for that time period. So once again, the pivot point, add to the pivot point, add another pivot point, and divide by 3. Friends, that is right there, as I'm showing you, a moving average, a 3-period simple moving average of a pivot point. And that's what I wanted to really highlight for you, is that if you take a day of, say, Wednesday, and then a day of Tuesday, and a day of Monday, if you add up and take the pivot points from those 3 days, add them up, that's going to give you the true typical price for those 3 time periods. That is a 3-period moving average of the pivot point. That's what this number is. And that number is giving you a truer reflection based on the values of the high, the low, and the closes for not only one session, but all 3 past sessions. So that, I think, is something that it's kind of a new twist for most of you, and especially if you've never seen my work before. Let's talk about this and show this in graphic detail. We've got our pivot point as indicated by our boxed line, and then let's take our longer term, what I call 3-period pivot point. What we're looking for in changes or market directions, for starters, I use a pivot point and a 3-period pivot point to help identify changes in the condition of the market. For example, if the pivot point is above the 3-period pivot point moving average, the market is also, and the market closes above the values, then we are considered to be in a bullish environment. If we are bullish, so let me draw this. So if the market actually, if it opens here and closes there, if this closed assigned value is above the pivot point and above the 3-period pivot point average, the market's considered bullish. So I want to be looking for buy signals near support. So if the market comes back and tests the support, if the market comes back and tests the support, if the market comes back and tests the support, and then again, our values are starting to do what? Develop into a uptrend with higher highs and higher lows. And that is something that we determine by looking at a true typical price moving average, not just a closing moving average. We want to be looking at a true typical price against, which is the pivot point, against a typical price moving average, which is the 3-period pivot point average. And that'll help give you at least an idea that there is a conditional change, or in this case, as we see, a bullish conditional change occurring. Now, I've introduced you to pivot points. I've introduced you to how you can identify the bullish or bearish condition. This is pretty advanced material here. I know the course started off slow, introducing you to Forex and comparing against futures, and all of a sudden we're into major mathematical advanced studies. But really, if you think about it, this is simple. But it's just so simple, no one really thinks about it, except for some very large, well-funded hedge funds and commercial traders. And I know for a fact, because I've actually taught a few hedge fund managers who have in excess of over $100 million this method, and they use it effectively. And at other managed fund conferences, I've discussed using a system similar to this with other very prominent traders. And I can tell you right now, a lot of them use this methodology. They all might have different twists, quirks, and idiosyncrasies and tweaks, so to speak, or optimize different variations of a moving average approach. But they're all using, a lot of them use a pivot point moving average to give them a true reflection of the market price. And since we do see in foreign currency a lot of wide swings in the market, if you averaged out the high, the low, and the close of a given time period, you'll get a truer sense of the market, and therefore you'll have at least uncovered a better value or trend direction of the market. Remember I said that pivots can help us identify the trend condition of the market? Well, here's a great example why. Now, when we go through trending market, or phases as I call them, the market goes through several different phases. For one, we're going to see the market go from a trend phase, and then sometimes we go through consolidation, and the market either reverses the trend, or sometimes the market can resume the trend. And in this situation, wouldn't this look like kind of like a bear flag in the marketplace? But a lot of times we don't know which way the market's going to break out, and you develop what's called these sideways channels in the market. Well, if you use the typical price methodology, sometimes you will see that the moving average slopes upward, and that may give you a hint that the breakout is going to be to the upside rather than the downside, and so therefore you want to look for buy signals near support and look for and take the buy signal breakouts a little more effectively, meaning don't disregard them. So if you have a moving average that can represent the true typical price, it's going to help you determine the true value of the market a little easier. Now let's take a look at this, which is our chart. We're using this is the Japanese yen against the US dollar, and this is a high-low close divided by 3 average against a 1 period high-low close divided by 3, which is our pivot point. So all we're doing is using our pivot point versus our 3 period average of the pivot point. And what I'm looking for is if the shorter term crosses, as I demonstrated earlier, remember that, and we have this type of crossover, right, and we have the market crossover, which it does right here, then I'm looking for another conditional change in the market. And that conditional change we haven't gone into in this course, which we will. But as you notice here, that this moving average has closed above the other moving average. But also notice, more importantly, the slope or angle of the moving average. It's higher, is it not? So as this market looks like it's, and even here, let's take a look at this. Notice the slope of the angle of the moving average is down. We have a sideways channel in the market. But yet the moving average is sloping down, and the market went down. Then we have the market in a sideways channel once again, kind of like maybe looking like a bear flag, except for the moving average is sloping up. And if we had a hint or something that could identify that there is a higher assigned value, such as a higher close than a prior high, potentially a hammer formation as we have right here. See these little hints that we're seeing in the marketplace right now? Our hammer, our higher closed than prior high, our higher closed than past highs, a hammer pattern, an upward sloping moving average. We have a clue that the downtrend is going from trend consolidation to trend reversal. Notice what we have happen. Lots of great stuff occurring as solid uptrend pursues. So sometimes it's important to watch the slope of the angle of the moving averages. Now, let's take it a little bit more in detail with our 3 period versus 1 period moving average. Our 3 period is in black, our 1 period or or pivot point itself is in blue. So notice that the market's in a consolidation. It's in a wide range. We have lower lows, we have higher highs. What's going on with this market? We have our moving averages ascending, sloping upwards. That's giving a hint that this market may be looking for a higher close or a breakout. Notice that if we look in here and we take a look at our moving average, we'll also notice the crossover, and that's what this arrow is trying to indicate for us right here. Notice that we are crossing over. Our moving average study value here, our moving average has crossed over, indicating that the price direction is changing from bearish to bullish. So as we start to see the market's now doing what? It's making a higher high. It also made a lower low, but that's all confusing. The true value of the market is showing that there's a change occurring and the market is getting ready to accelerate to the upside. And sure enough, here we have our moving averages indicate the change in condition first, giving us a buy signal. Notice here, as the market peaks out after this trend run develops, the market goes from uptrend, it consolidates a bit, and then all of a sudden we reverse the trend. If you can remember, those are the 3 phases of market: trend, consolidation, reversal, or resumption of trend. That'll be very important for you in your trading careers. But here, notice that we see the market. Is it just pausing, getting ready to advance higher? Well, let's take a look. We have downward sloping angle in our moving average, number 1. Our moving average crossover definitely illustrates that there's a change in value, and that's triggering a sell signal in the market. If you can notice that, it's subtle, but these subtle changes, there's someone out there that is also watching those subtle changes. Also though, notice that that low, the market closed below a prior time period's low. by using the 1 period pivot point against the 3 period moving average of the pivot point, you have a better idea of a faster change, and it's more sensitive to a conditional change in the market. After all, that's what we're after. I need to know when the condition of bull trend is going to end, when the bear trend is going to end, so I can join the trade, the trend, the momentum. That's all. I'm not looking to see if the British pound is going to go to 200. I'm not looking to take delivery, and I'm not looking to become a bank. I'm looking to capture a short-term trade, and I'm looking to stay on the right side of the market. If I can identify where the market is ending, I'll be a much happy camper when it comes to trading in the markets. Now, moving averages. This opposite is true. If we're bullish the market, the pivot point is going to be above the 3 period moving average of the pivot point. But when that line crosses, that gives us a bearish change, a conditional change in the market. That will also help us possibly target the R1 down to S2 for our market analysis. In addition, if we use the moving average components and we see that the market's in an uptrend, and we see that the moving averages are sloping to a downtrend, it's showing us that there's a truer value or a reflection that the market may not resume an uptrend, it may reverse the uptrend. Now, this is a chart from our Genesis program, which gives me predetermined, based on what I'm teaching you already in front of us, what the market is doing. The blue line represents our targeted pivot support. Our gold line is representing our 3 period moving average pivot point. This orange line is, of course, our pivot point. So if we're bullish in the market and we have a change in condition of these moving average values, an arrow will flash indicating a buy signal for us. So we understand if we're near support, not to take sell signals, look for buy signals. And if you buy support and if you sell resistance, you'll be a much happy camper. Notice here we have that buy signal. It's generated. The buy signal is generated on the close of that candle, not after this big move like other indicators might give us, such as stochastics or MACD or various forms of other moving averages. This gives us an early warning signal and tells us before the market takes off. Now, if the market starts to indicate a sell signal, we want to, as a trader, exit our long position. This is a beautiful trade that we see in the euro currency that would give us a buy signal close to 119.15 level and would have us out near 119.65. So a very nice 50 pip move in a very short period of time. Notice though, is this trend going to continue? Notice the sloping angle of the moving average components. Even though the market made higher highs, we're in a chop range, but the true value of the market, the hidden value as I call it, was shown clearly. As you see here, the moving average values were on a downslope, and what happened? The market reversed the trend. So we went from uptrend, consolidation, to trend reversal. It's a very similar pattern. It reoccurs. This is not the same chart. This is a different chart, different day, different time period, but the patterns reoccur over and over and over again. Market values, 3 period, 1 period. We see a change in the market. We see the slope as almost equal, no change. But notice that the market crosses over. The moving average crossover, we see a lower close. We see a signature low close doji trigger here. And of course, the market continues lower. So the moving average values will help you identify change conditions. It'll help you to identify where the true condition of the market is, whether it's bullish or bearish. And that, my friends, you're going to be able to better select what pivot numbers to use as your support and resistance and have better, cleaner, faster trading decisions to be made on. Now, one thing I want to mention is about gaps and market gaps, and I call it the gap band, and this is something that we teach in our university, but also more importantly, if the market gaps, and I want to show you here, because a lot of people use a 5 period, a 13 period, an 8 period, a 10 period, 20 period, 50 period. Everyone has a different period they want to use. But one thing that you got to look for is what we call regression to the means or departing too far from the means. And if that's the case, if a market departs too far from a traditional moving average, I got news for you. You want to take out your monthly or weekly pivot point calculations for an idea of a market reversal. Now, moving averages helps clarify or illuminate market's price flow. They help paint the picture when the market departs from the mean, especially as it gets too far away. The mean meaning a moving average. That's what that means. A mean is referring to a moving average. If it departs too far from the means, it's going to regress to the means. Either price is going to come back to the moving average, or the market will pause, allowing the moving average to catch up to prices. Now, when prices reach what I call an unsustainable price extreme, we either are looking for a counter trend trade, and therefore we'll take our pivot point numbers out, our monthly or weekly or higher degree or higher time frame numbers out to help spot a potential reversal area. So, a lot of traders will use what was called regression to the means. And that means if the market, simply put, if the market departs too far from the moving average, it's going to return to the moving average. So look for a counter trend trade. And by all means, if the market stretches too far, too fast, and becomes what we call overbought, you definitely don't want to be going long on that breakout. So as prices depart or get too far away from a moving average or a band, it gives an opportunity, as I just mentioned, for a counter trend trade. Another way to describe this is when a market deviates or departs too far away from the moving average, it gives you an opportunity for a speculator to take advantage of that condition. And that generally ends up, the prices reach that unsustainable extreme, and they'll return back towards the moving average. Let's take a look here. Here we have the euro currency, or excuse me, the British pound. And notice that we're looking at our 3, 9, and this is a 19 exponential. You can experiment and use a 3, 9, 18. You can use a 3, 9 weighted 18. You can use a 5 and a 10 period moving average. You can use a 5, 10, 20. Many traders use various forms of moving averages. The bottom line, though, is if the market has been normally hugging its longer term moving average, if it departs, if it gets too far from the moving average than normal, okay? See, normal would be a standard deviation of a certain degree, but if it gets out of that standard deviation, the market is either going to return to the moving average or pause, allowing the moving averages to catch up to prices. And then, from this point of crossover in moving averages, prices will reverse. Remember, I just talked about this. Trend, consolidation, reversal of trend. By the way, this is a daily chart. A daily chart. And what I've been showing you are different charts, different time periods, and different markets. This British pound trade here, notice the market then departs too far from its moving average. What happens? It pauses, comes back, tests or check or regresses to the means, and then chops around, and then again departs too far from the means, then it comes back, and then again it departs too far from the means, and it'll come back or pause, allowing the moving average. So it is in these time periods that the trend condition you want to identify, has it gone too long and too far, and by using moving average, that can help you. Guess what? I use the 3-9 simple exponential moving average just as a tool to help identify those gaps. It also applies to the 3-period and 1-period pivot point averages. Now, the next chart is euro currency. Notice that the further away or the larger the gap is, the more room for a reversal. In other words, we see the market, the fair value is probably closer to the 9-period rather than the 19-period moving average. Notice that the market really accelerates and it returns back to the moving average. The moving average will act as support, and the market deviates, departs too far from the means. It leaves and that's what I'm trying to show you here in this example. It gaps. It leaves a gap, too much distance between price and the moving average. And every time we see that gap or that departure from the means, the market wants to return or regress back to the moving averages. So how is this helpful? Well, guess what? If we're looking at February, and of course these are daily charts, and March and April, guess what? We probably want to look in the 1st of March, sometime in this time period here, we want to look at what? Our monthly numbers. imagine if we had a monthly R1 or an R2 number near this high. And if we belong here at this moving average, if we belong here, but we're way up there, we're probably going to look for a selling opportunity. And who knows, sometimes the market keeps going and keeps giving and keeps giving, and we're going to have to follow some trend trading techniques. But that's what I'm trying to explain to you. In a given time period, if the market in a given month, this is, for example, December, and we go through January, in a given month, if we're near our resistance numbers, or more importantly, near our monthly support numbers, we can box in what the true value of the market is, therefore giving us an added bonus market analysis of how to trade the market, either selling at projected resistance or buying at projected support if the market gets too far apart from the means. So when the market gaps too far from the moving averages, that's when you can use your monthly and weekly target numbers to help target a reversal point. And that moving average will act as what we call fair value gauge. Therefore, you can determine if the market is substantially overbought or oversold. So I wanted to go through the various means and methods that you can use and when to apply pivot point analysis. We've gone over a moving average approach. We've gone over how to select and filter out the numbers. We've gone over a gap band feature. We've gone over a conditional change feature. We've gone over how to identify if the market closes above the pivot point, how to identify if the market's in a bullish or bearish condition, and therefore how to filter or select the right pivot numbers. Now, that's the conclusion of part 1 of Forex Conquered trading course.